Another result that we have been tracking is Aurobindo Pharma. It came out yesterday post-market hours, in fact late last evening. Pankaj Podar, who tracks the company very closely, is joining us now on the show. Pankaj, what is it that the management highlighted in the conference call this morning?
Right, so it was an interesting conference call, Movina. When you look at the numbers, it was particularly on the weaker side, whether you look at margins, whether you look at higher R&D. The key takeaway was that the company has received the EIR for Unit 4, which is their biggest facility, and Unit 12, which is another injectable facility that they have. This was one of the key overhang for the counters, and probably that's the reason why, now the reports that come out tomorrow or maybe throughout the day today would become interesting, because will people cut FY19 EPS estimates or not? That's something, which is likely to see in this quarter. In terms of injectable, most of the sales loss that happened in injectables was due to the recall, and that's the reason why, there was a couple of write-offs as well, and that's why Q4 cannot be looked at on a standalone basis, is what the management said. Ipotrim, which is one of their key important drug, which is about 10 rupees of the entire SOTP valuation of Aurobindo, the management very clearly said they expect the approval of this in the next few days. A few formalities are left, and that, according to them, should complete quite easily. What's the importance of Unit 4? As I told you, most of their filings come in from there. Most of their filings are from there. It's an important unit that they have, and that's the reason why the EIR coming from there is essentially quite an important one. There were 9 observations, and some of them were looking in on the serious side, according to most of the FDA expert, but still Aurobindo has got this clearance. So that's the key takeaway. Also, let's listen into the con call. We had ace investor Rakesh Jhunjhunwala, who has taken Aurobindo Pharma, quizzing the management. Let's listen.
But the increase in what kind of interest cost do we anticipate for 18-19?
Sir, this year we have, this quarter Q4, we ended with an interest cost of 2%. Our interest cost is predominantly foreign currency denominated. So, depending upon the Fed rate hike in the interest rate, our interest cost also move accordingly. But it will be slightly below them because we are using other currencies also.
Right. So if the Fed rate goes up by 75 basis points, our interest cost should also go up by 75 basis points.
Yes, sir.
Right?
That's true, sir. It will be slightly below, but nevertheless it will be of that range.
And how do you expect the inventory and the working capital to increase next year? If you are planning for higher sales, that leads to higher working capital. But if your inventory is going to be normalized and you're carrying excess inventory today, what will be the increase in working capital next year? Suppose your turnover goes up by 15%. How much will your working capital go up by?
Sir, we have if you see the balance sheet, we have on an average the working capital is around 40% of the turnover. If the increase in the turnover by about 15%, as you said, the working capital also will be similar or maybe slightly lower.
Then why do you, suppose I say your EBITDA grows, your profit next year say 2,400, I say 2,400, and you have depreciation rate at 3,200. If you have $175 million of capital expenditure, right? Why will your debt not go down further? Why it will go down only 100 million?
Sir, it is like this. When the turnover goes up by 15%, even though the working capital to turnover ratio, percentage remains the same, but the absolute amount will go up in line with that.
So the sale goes up by 2,000, your working capital go up by $120 million. So $300 million is your increase in working capital and capital expenditure. Your profit plus depreciation is $600 million. It's about $550 million. So why should your debt go down only by $100 million?
Sir, take the example which you said. If the turnover goes by $200 million and with the working capital ratio at around 40%, so the increase in the working capital may be $80 million.
And 175 is your working capital, so 250.
So 80 million will not happen. It may come down by around 60-70 million. So that will be the incremental working capital required for the in absolute amount.
All right.